David Burrows of Barometer is here taking your questions on North American large caps at 1-855-326-6266. That's how Stephen got a hold of us in Peterborough, Ontario. He joins us now. Hi, Stephen.
Hey, how's it going? I was just calling about Canadian Tire Corporation, Equity Toronto.
Okay.
Obviously not a cheap stock, but I was wondering what the outlook looks like in the long term there, especially with the Canadian dollar looking to go down this year and the competition for the price-earning ratio.
All right.
Sure. So, Stephen, you're asking a question about the right sector. You know, we're in a very interesting market because correlations sector to sector are coming down, meaning some sectors are doing great, others having a difficult time. You know, weak energy, tough for the energy sector, weak energy, great for the consumer. So, U.S. market, you know, 72% is the consumer in the U.S., the consumer sector doing very, very well. In Canada, really it's the best performing sector of our market, and you could almost throw a dart at any of the retailers and see something that's heading higher.
Well, be careful about that.
So Canadian Tire performing very, very well. If I had to choose something in this space, I would probably focus on Home Depot, but before I would Canadian Tire, although I think you do just fine in Canadian Tire. You know, the consumer has a little more money in their pocket. Canadian Tire and Home Depot are the types of stores that people are visiting to spend some of that extra money. In the Canadian market, retail is only about 4 or 5%, whereas in the U.S. it's 15, 16%.
What do you make of Stephen's assertion that Canadian Tire is expensive? It's 16 times forward earnings, whereas Home Depot is 23 times forward
earnings. You know, look, you pay for quality. Right? And I don't think you should ever be afraid for paying up for the winner or the leader in an industry. You know, in Home Depot's case, they went into the recession in 2008 with margins at 7%. Today, they're 12%. Same-store sales are up 6.6% versus the U.S. economy growing at 3%. You know, so they really are winning, and they're gaining market share. But Canadian Tire is a great company. It gets you exposure to the right sector. They're doing a great job. Stock's behaving well. I have no problem buying the stock.
Stephen, thanks for the call from Peterborough. Vancouver now for Jerry. Good afternoon, Jerry. Welcome to Market Call tonight.
Good afternoon, gentlemen. David, can you please give me your views on Cisco Systems? I was looking at some of the matrix on them, and looking at net profit margin is 16.2, EPS growth is negative at 19.5, and your income is negative at 21.3. What do you make of that, and would you be a buy, seller, or holder of this one? Thank you.
Sounds like Jerry's looking for a job at Barometer.
So, Jerry, first of all, you know, the way we look at the world, U.S. equity market is seeing net money get put to work. And we say that because the percentage of stocks performing well is rising, meaning more money is getting put to work. When I get down to the sector level, there are only 4 or 5 key sectors that really are leading this market. Technology is one of them. Now, there's 2 types of stocks that we look at in technology right now. One type is those companies that are in high growth industries with something very special, some special pricing power that can give them revenue growth, which is hard to come by really in any sector. The other, though, type of technology company that we are invested in currently are big cash flow generators. Companies with big balance sheets that are generating lots of cash, buying back stock, and have really defensible business models and strong market positions, and Cisco would be one of those companies. Now, you could look at a Cisco, you could look at a Hewlett-Packard, you could look at Intel. I mean, there's a bunch of these. They are not high-growth companies. They are not something you're buying for a moonshot. People will pay for predictable cash flow right now. And I think that old tech is one of those neighborhoods that you can look at. So, you know, Microsoft reported tonight, and they disappointed a little bit, stocks down a bit. But again, that's one of those old tech companies. Probably that should be bought on any bit of weakness after the earnings.
All right. Jerry, thank you for joining us from Vancouver there. As far as Cisco over the course of the next 12 months, street consensus is that it's already pretty fully valued at this $27, $28 mark. Would you pick it up, see where it goes, and just clip the 2.7% dividend? So
here's the issue, is that when you wind up with a sector that is being revalued versus its recent history, when so 2 things drive share price. One is earnings growth, and second, what multiple are you prepared to pay for those earnings? And the problem that people are having with the U.S. market right now is they're saying, well, the multiple's higher this year than it was last year, and it was higher last year than it was the year before that. That's what happens in a secular bull market. And we believe we entered a long-term bull market for equities 2 years ago, and you are likely to see continuous expanding multiples, which will make them consistently look expensive versus the previous year and versus the year before that. But corporations have lots of cash, and they are looking for productivity, and they will spend for that. And these companies like Cisco and a HP and an Intel will benefit from that.
We're going to take a brief break. When we come back, we're going to look at the past picks from this time last year, up more than 12%, when the equity market's up only 7%.